have Anna Taylor from Live Oak Bank. She is the Vice President of Self-Storage Lending. Am I saying that correctly?
Yes.
Awesome, Anna. And we are going to go through how SBA loans can help grow your business. So, Anna, I'm going to let you give a quick 30-minute rundown of who you are, who Live Oak is, and what you do for them, and then we'll jump into your presentation.
Sure. Yes, absolutely. So as Jessica mentioned, I am a VP of Self-Storage Lending at Live Oak Bank. Live Oak Bank is a digital bank focused on small business loans. So we are actually the largest small business lender in the country by dollar volume, and we have a specific team built out just to serve self-storage owner-operators. So I have been lending exclusively to self-storage owner-operators since 2015. And to date, our team has done over $800 million in loans to small business owners in the self-storage industry.
That's awesome. And I know Terry Campbell's part of your team over there, and he's also a self-storage owner-operator. So you can't get any better advice than, somebody that's doing this day to day. So thanks for joining us, Anna. I'm going to let you take it away with your presentation. If anyone from the audience has questions, please feel free to ask those through the chat or Q&A button. And if I have any, I'll pop back on screen and ask them for you.
All righty. Thank you so much. All right. So a lot of times when I tell someone I'm an SBA lender, people kind of look at me like, what even is that? So SBA stands for Small Business Administration. So it's a government body that was set up back in the 50s. And basically their mission is to help Americans start, build, and grow businesses. They provide consulting services. They have lobbyists on Capitol Hill to promote small business interests. And they also have loan programs, both direct loan programs where people can apply to the SBA for a loan, but they also have government guaranteed loan programs that banks such as Live Oak Bank can use to lend to people that want to start, acquire, expand a small business. So some people may kind of look down their nose a little bit about SBA loans, but truthfully, there are a lot of really incredible companies that either got their start or grew early on through the help of the small business loan program. So Chobani, that delicious Greek yogurt, he actually got an SBA loan to start his first factory creating that yogurt. Under Armour, the athletic apparel company, also got its start through SBA loans. And then Chipotle and Ben & Jerry's, two super delicious food companies, they got their early start and grew through small business loans. So there are a lot of really cool companies that have grown with the help of SBA financing. So SBA loans, kind of what are they? How are they different than traditional loans? And I'm guessing most people that are in this conference are familiar with traditional loans. If you're going to buy a facility, you go to a bank, you put 20 to 25% down, you get a loan to buy a facility. If you're building, they probably want to be in a 65% loan to value. So how are SBA loans different than those traditional conventional loans? So first of all, I would say the difference is structure. Using that small business loan program gives me a lot of cool leeway to build in working capital or interest only periods into the loan that may not be available in the conventional market. I would say the thing that draws people to the program the most is definitely the higher leverage. So with small business loans, we can do up to 90% loan to cost. And if you're an existing owner and you've got equity in your business, we can do 100% financing on expansion. So most people come to the SBA program because they're interested in that higher leverage. And if it makes sense, it's a better cash on cash return for them. SBA loans for self-storage facilities have a really nice 25-year amortization. There's no balloons on that either. So it's 25 years, both amortization and term. A lot of traditional loans are either, 20-year amortization due in 5, 20-year amortization due in 10. But this one, both amortization and term, 25 years, which really helps shrink your monthly payments. No covenants on an SBA loan. So basically, if you get an SBA loan, you just need to make your monthly payments and you can kind of keep going. With conventional loans, they can build in some covenants that have real teeth into their financing. And one that I'd like to highlight is a loan to value covenant. I've spoken to a lot of self-storage owners that have been in the business for 15, 20 years. And they remember, 2007, 2008, when the Great Recession hit. And if they had a loan to value covenant in the loan, they were in trouble. So, the recession hits, but they're doing fine. They still have people in their units. They're still paying their payments to the bank. They're staying current. But if they had an LTV covenant, because real estate values dropped through no fault of their own, banks can and did call the loan based on that LTV covenant. So I've spoken to some people that it triggered a personal bankruptcy for them because the bank called their loan. It's 2008. Nobody's lending. And they had to do a personal bankruptcy or they lost their facility. So the covenants piece can be really important. So I would encourage anybody, regardless of what type of financing you receive, look at that fine print to make sure that the covenants aren't there to kind of hinder you. So SBA loans, it sounds great, right? You've got working capital, interest only, it's high leverage, nice long term, no covenants that can scare you. But I think there are some trade-offs. There's some limitations with an SBA loan, like if you wanted to use CubeSmart or Extra Space as third-party management, can't really do that with a small business loan. Interest rate tends to be a little bit higher on SBA loans than compared to conventional loans on average. I'd say fees are a little bit higher as well. So I put this scale on this slide just because I think when you're looking at financing, you need to think about what's most important to you and kind of balance what's important and figure out what the best fit is going to be. So, is it leverage? Can you only afford the project if you're putting 10% down versus 25? Or is it, hey, I can do this project without taking on investors if I do an SBA loan? Or if it's, like, hey, I need to use Extra Space as third-party management, maybe SBA loan isn't the best way to go for your financing route. So it's really about finding out what's most important to you and then finding the loan product that fits those needs. So now that we've talked a little bit about SBA loans kind of in general, I thought it would be a good idea to speak specifically on a couple of projects that I've recently financed. So I picked one, new construction of a facility in Tennessee. And so I used an SBA loan to finance this one. And most importantly, I put in 3 years of interest only. I think a lot of banks look at a construction project and say, oh, it's just a construction project. The risk is in the 9 to 12 months of construction. When for self-storage, yeah, you've got construction, but you're rolling right into a new business that needs to lease up a little bit before it's ready for full P&I payments. So that 36 months of interest only helps you get time to build it, but also lease up to a point where you're comfortable before full P&I payments kick in. For this loan, I budgeted in an interest reserve for the construction period, but I also put in a working capital reserve for lease up. So this was a loan that was right around $4 million. And the working capital that was needed to take the project from the end of construction to break even was $350,000. So that is so key because it supports you through that lease up period, which is where all the risk is going to be. There's also not a balloon here. When you're building new, if you've got a balloon that comes and your maybe construction took a little bit longer, or maybe your lease up isn't going quite as quickly as you hoped it would be. If you're not in a good position to get permanent financing when that balloon hits, you may be stuck with less attractive bridge loan options, which are usually expensive to get in terms of fees, but also have really high interest rates. So it's kind of nice if you choose an SBA loan for new construction, you've got the support of the working capital and the interest only, but you also don't have to worry about a balloon hitting you at the wrong time in your lease up. And then most importantly, when we look at this project, we're looking at land cost, construction costs, interest reserve to get you through construction, that working capital to get you through lease up, the closing costs. Add it all together, the borrower is coming in with 10% as their equity injection. So the bank is doing 90% financing on total project costs, where a lot of other lenders are saying, I want 35% down on hard costs, and you have to self-fund the lease up yourself. So for another SBA loan example, I chose an acquisition. And so I'm sure everybody in the self-storage industry is aware it is definitely a seller's market right now. They are commanding high prices and they're getting them. Cap rates are compressing lower and lower. So not all acquisitions are going to be a fit for a loan where you put 10% down, right? You're not going to be able to go get an SBA loan to buy a CubeSmart in downtown Miami that's leased up. That's not going to work. So where I see the sweet spot for SBA loans are these kind of diamond in the rough turnaround opportunities. And I'm sure people on this call, about it. It's a facility that's probably in a great location in your town, but the seller has holes in the fence. The gate is just open because it's broken and he doesn't feel like he wants to fix it to get it to close again. He doesn't have a website. He's got people in there that he hasn't raised rents on since the 90s. So it's something where you're buying it not for what the seller is doing with it by any means, but for what you can do on it. So while we take the seller's historical financial information into consideration, we're really underwriting it based on the projections of the buyer. What can they do with this facility? So a lot of times I can build in working capital to help them fix the gate, repaint the doors, and then also build in some interest only as well, so that they can make the changes they need, get that cash flow up before full P&I payments kick in. And again, because this is an SBA loan, I'm able to finance all of this on a 25-year amortization, and the borrower comes in with about 10 to 15% as their equity injection. So if all of this sounds good to you and you're like, this SBA loan sound great, I really want one, how do I get one? Let's talk about what does it take to get approved. So if I had to boil down what it takes to get approved, I would say you have to check kind of two separate and distinct boxes. Number one, we're looking for a good project, right? We don't want to lend on something that's not going to be, financially profitable for you. But we're also looking to lend money to a good person. And I'll get into what I mean now. So for a good project, to me as a lender, cash flow is king. I want something that can support its debt payments, obviously, but I also want something that's going to be able to provide a profit to the small business owner. So many lenders, they approach lending kind of with these blinders on with LTV, like they want to be in a 75% LTV because if the loan goes bad, they want to be able to sell it and be made whole. I would rather lend on strong cash flow so I can say, hey, there's plenty of cash flow here to make these payments. I'm probably never going to have to repossess this self-storage facility. So how do we measure cash flow? First, we're going to get historical financial information from the seller. That means collecting their tax returns, collecting their P&Ls, collecting, general ledgers, or maybe even bank statements if they don't keep the cleanest books, to see kind of what is the net operating income of the business. And we're savvy. We've seen a lot of, sellers who have their son's car payment expense through the business. We can add that back to cash flow. We'll take a look at the rent roll too to see, does he have one of his buddies has like 4 units for free? That might be an opportunity for the buyer to, okay, I'm not going to, keep giving those units out for free. We'll also look at the management software reports if the seller has management software to kind of see how the business is doing. So we can kind of layer the debt on how the business has been doing in the past. But then we also collect projections from the buyer, especially in those kind of turnaround diamond in the rough scenarios, to see, okay, that's what the seller did with the business, but here's the buyer's projections for what they're going to do with the business. And we'll want assumptions too. You can't just say I'm going to triple NOI in 3 months. Like it has to make sense. But if you can say, hey, I'm going to add a website with online booking, I'm going to start accepting credit card payments, I'm going to, make it so that people can book 7 days a week, and here's kind of my plan on rental rate increases, then we can say, okay, those are some projections that we can get behind. So how do we measure a good project if it's new construction, right? Because if cash flow is king, how do we measure cash flow of something that's not there yet? And so for new construction, we require a feasibility study by an industry expert. And here's why. First of all, you need to have somebody that is totally impartial to tell you, is this a good idea or not? And I boil it down to, I've got 2 little kids and I think they're so cute. They're the cutest kids in the world. And why do I think that? Because they're my children. I love them. They could be the ugliest kids in the world. I wouldn't know. I'm blind to it because I'm their mom and I love them. So sometimes if you have your project and it's your baby, you need someone that's able to kind of look you and say, you've got an ugly baby, right? So, high level, it is kind of a yes or no. And I remember when I started lending in self-storage back 6 years ago in 2015, I said to my boss, Terry Campbell, who's been in the business for 25 years, I said, why do we require these feasibility studies? They always come back positive. And he said, listen, Anna, after the recession, banks didn't want to lend to self-storage. They didn't want to do construction loans. Nothing was built essentially for like 7 years. So there's going to be a lot of pockets where there's a lot of pent up demand for self-storage, but just wait to see kind of as the business cycle changes. And he's so right, because now, there's been an explosion in self-storage construction from 2018 to 2021, just an explosion. And there are tons of markets that are saturated. And so that feasibility study is so important. And if you have to pay $2,500 to avoid making a $6 million mistake, I would say that's money well spent. So the feasibility study is not only going to say, yes, move forward, or no, don't do it. They also give you a lot of really good information. It's going to give you kind of a deep dive on your competitors. They're going to mystery shop them to figure out what's their occupancy, what are the popular units. From the information on your competitors, they're going to recommend a unit mix. And the recommended unit mix is different depending on the market. So they might say, hey, don't do any small units. Super big units are really popular here. Or you should build exclusively climate control because the rates are so much higher for climate control compared to non-climate control. So that's really helpful, especially if you're newer to the industry and you're not really quite sure what the market wants. Lean on that industry professional. And then one thing that the feasibility study will tell us in tandem with your construction costs is it economically feasible? Because, if you're in a market where there could be a market where every facility is full with a wait list and people need more self-storage, but the rates there are low. Like you're getting like $60 for a 10 by 10. If you have rates that are that low, the potential revenue of your new development just doesn't justify the cost of construction, especially since the cost of construction has skyrocketed in the last 18 months. Cost of labor is up. The cost of raw materials, such as steel, is way up. So sometimes, there could be demand for more self-storage in your area, but the construction costs just don't make it so it doesn't pencil out. Like you'd have to put 40 to 50% down before you'd even break even in a reasonable amount of time. And then the most important thing the feasibility study provides for me as a lender is monthly projections. And I use those monthly projections when I'm looking at a project to say, okay, how much interest only do they need to get to break even? How much working capital do they need to get through the lease up period? So I really, really lean on those projections. And then the last piece is we're good people. An SBA loan does require a personal guarantee. And so we need to kind of do a deep dive on the borrower to make sure that they're bankable. So easy stuff. You got to have a good credit score. We like to see 650 or higher with no major blips, no major delinquencies. We like to see strong income. We don't want to see any bankruptcies or defaults on government debt. That's going to make it really tough to get an SBA loan. We also like to see a 50% debt to income ratio, just to show that you're kind of living well within your means. I don't want to lend to somebody that's got a $6,000 mortgage payment and a Ferrari lease if they're making $40,000 a year. And then liquidity is important too, not only to see, do they have enough money for the equity injection, but also do they have enough money after the equity injection? Because I never want to take all of somebody's cash with my equity injection. I'm not a heartless lender. I know that it's always good to have kind of an emergency reserve if something goes bump in the night for either you, your family, or the facility. And most importantly, we're looking for people that have a strong plan for success, that can say, I want to buy this facility because, or I'm going to build in this area because, and here's how I plan on running the facility to make sure that it's successful. So kind of if we get a good project and we get a good person, that's kind of what it takes to get approved. So at this point, I'd love to just open it up to any questions.
Yeah, Anna, I'm here. Jessica's back on screen. I have one quick question for you. We ran out of time, unfortunately, but I will toss this one out there quickly. Are people able to get multiple SBA loans at the same time?
Yes, absolutely. So there is kind of a cap on the amount of loans that you can get. But I've got customers that are on their 4th, 5th, 6th SBA loan with me. So you can get multiple loans. It's all about kind of measuring against your limit, but there's also ways to get additional SBA financing if you utilize green technology like solar panels or geothermal heating.